Look at a price chart and you experience a strange double perception. On one hand, the movements look chaotic, unpredictable, noise. On the other hand, there is an undeniable sense of structure underneath. Repetition, rhythm, something ordered just below the surface. Both of these perceptions are correct, and market structure is the discipline of revealing the hidden order inside the apparent chaos. Look at the two charts on this slide. They contain the exact same candles, the exact same data. On the left, it reads as random. On the right, once we mark the higher highs and higher lows, a readable trend emerges from the same information. Nothing about the market changed, only the lens changed. Everything in this entire course is assembled from just two primitives. The first is market extremes, highs and lows, the swing points and fractals that mark potential reversals. The second is location, where price currently sits in relation to previous market extremes. That is it. Extremes and location relative to extremes. Every concept you will learn today, break of structure, market structure shift, change of character, strong and weak highs, all of it is built from those two ideas stacked on top of each other. Market structure is the underlying logic that governs how price action unfolds over time. Let us define market extremes objectively, so there is no discretion involved. A swing high occurs when a candle has a lower high to its left and a lower high to its right. Look at the left chart. The middle candle is the peak. Both neighbors have lower highs. That is a confirmed swing high. A swing low occurs when a candle has a higher low to its left and a higher low to its right. That is the right chart. The middle candle is the trough. Both neighbors have higher lows. Now here is the critical framing. When a swing forms, you have a potential reversal because every significant price reversal is a swing. But, and this matters enormously, not every swing is a significant reversal. This concept in isolation will generate a large number of false signals. It must be contextualized with other concepts before it becomes a high-quality trade. Inside the right context, it becomes very powerful. Alone, it is noise, the same idea generalized. A fractal high is the candle with the highest high among an odd number of candles, usually 3 or 5. A fractal low is the candle with the lowest low among an odd number of candles. On the left, a 3-candle fractal high. The middle candle has the highest high of the 3. This forms quickly, which means you get the signal early, but it is noisier. On the right, a 5-candle fractal high. The center candle has the highest high across all 5. It takes longer to confirm, but it is a cleaner and more reliable reading. Same concept as a swing point, expressed with a wider or narrower window. Pick your trade-off, speed or reliability. Now we take the definition and overlay it on top of itself. This is where it gets interesting. A major swing low happens when a swing low has a higher swing low to its left and a higher swing low to its right. Not just a higher low, a higher swing low. You are applying the definition recursively. Look at the chart. The two teal markers are minor swing lows. The amber marker in the middle is the major swing low because it sits below both of them, and both neighbors are themselves confirmed swings. Why does this matter? Because that higher minor swing low on the right-hand side is often an early indication of a more significant reversal to the upside. It is your first tell before the crowd sees it. The same logic inverts for major swing highs. A swing high with a lower swing high on either side, and the minor swing high on the right becomes an early warning of a significant move down. Once you can identify extremes objectively, you can categorize how they progress. And the market has two fundamental states: trending. An uptrend is characterized by higher highs and higher lows. A downtrend is characterized by lower highs and lower lows. And ranging. A sideways market is characterized by flat highs and lows, also referred to as equal highs and equal lows. That is the whole taxonomy. Trend in either direction and range. One consequence worth holding on to. In a sideways market, the up move and the down move are roughly the same size, which means the concepts of range and pullback, which we are about to define, lose their meaning entirely until a trend returns. Since the market has different states, and since you trade each state differently, the transition between states is critically important. In classic smart money language, the moment the market changes from one state to another, is called a change of character. Trend to range, range to trend, or trend to opposite trend. Look at the chart. Left of the dashed line, a clean uptrend making higher highs and higher lows. Right of it, the character has flipped. Lower highs, lower lows. Now, two nuances that most teaching skips. First, price does not necessarily oscillate politely between range and trend. Sometimes it simply changes trend abruptly, with no ranging phase at all. Second, a change of character can occur with, or without, a market structure shift. Those are two different things, and we will untangle them shortly. When you look at two opposing market movements, it is useful to classify them. In an uptrend, the range is the move to the upside. The pullback is the move to the downside. In a downtrend, invert it. Here is the rule of thumb. When the market is trending, the pullback is always smaller than the range. That size asymmetry is what a trend actually is. And when the market is ranging, the range and the pullback are roughly the same size, which is precisely why the distinction dissolves in a sideways market. So the relative size of these two moves is itself a diagnostic. It tells you which state you are in. Here is something that took a lot of traders far too long to learn. High-quality trade opportunities have one thing in common. They are born from valid pullbacks. Not any pullback, valid ones. And there are 4 criteria. Number 1, a valid pullback occurs within an established trend. This increases the probability that the pullback will not violate the previous strong market extreme. Number 2, a valid pullback gives explicit and implicit signs that it will in fact respect the main trend. Explicit signs are visible in price action alone, such as obvious deceleration as the pullback approaches its end. Implicit signs cannot be seen in price alone. Order flow patterns and momentum live in this category. Number 3, a valid pullback provides explicit and implicit signs of initiation after it has shown signs that it will respect the trend. So first it decelerates, then it refires in the direction of the trend. Order sequence matters here. Number 4, a valid pullback occurs in an area of interest, meaning a place near strong structure. The reason is risk. You need to minimize risk and maximize reward using logical stop-loss placement, and that is only possible near structure, which leads directly to a behavioral trap. Deeper pullbacks tend to be more reliable purely because of their risk management profile. You are entering near structure, so your stop is tight and your reward is maximized. Look at the left chart, a shallow pullback. Your entry sits far from any structure, wide stop, poor reward to risk ratio, and critically, it lures you into entering the market too soon. Now the right chart, a deep pullback into a demand zone, sitting right on top of strong structure. Tight stop, clean reward to risk. Here is the honest part. You will absolutely see shallow pullbacks work. Frequently, but that is exactly what makes them dangerous, because it trains you to enter too early and too far from structure. The safest approach is to wait for a valid pullback with all 4 qualities and trade only those. You can get away with shallow pullbacks if you are simultaneously tracking major and minor flows with a lot of care. That is an experienced trader's game, not a beginner's. Whenever the market breaks a previous extreme, you have a break of structure. Why does this matter? Because a break of structure relabels the chart. 2 things happen simultaneously. The origin of the movement that broke structure becomes a strong market extreme, and the market extreme that got broken becomes a weak market extreme. Look at the chart. Price rallies, pulls back to form a low, then rallies again and breaks the prior high. The moment that break occurs, the low that launched the move becomes a strong low. You care about strong extremes for one very practical reason. There is a higher probability that they will not be violated, which makes them safer places to put your stop-loss orders. This is also why we take supply and demand zones that come out of strong market extremes and generally ignore the ones that come out of weak extremes. The strong ones are simply more reliable. Now let us be precise, because this distinction is where a lot of traders get lost. In an uptrend, the highs are considered weak structure, so when price breaks those highs, you have a break of weak structure. That is routine trend continuation. It is what an uptrend does for a living. Some people call this a liquidity sweep. And here is where we need to be careful. The problem with that label is that it assumes intent. It assumes that every time price breaks a weak structure, smart money is deliberately using liquidity as a mechanism to reverse direction. That is not true. Sometimes it is. Often it is not. The market does not follow liquidity. The market follows value, and value means different things to different market players at different times. We will unpack exactly why in Module 8. Now, if the market is in an uptrend and price breaks a strong low, that is a completely different event. That is a break of strong structure, and it is far more significant. It also renders the high that originated the move as strong structure. That event is what we call a market structure shift. A market structure shift happens when price violates a market extreme that, in theory, should not be violated. In an uptrend, that means the market violates a low. In a downtrend, it means the market violates a high. It is called a shift because it shows a shift in control between market players. Buyers were driving. Now sellers are. There are two variations of this event, and they carry different meanings. A market structure shift that comes from a break of strong structure, and one that comes from a break of weak structure. Let us look at both. On the left, the market structure shift from a break of strong structure. Using an uptrend as our example. Price makes a higher high, which renders the previous low as strong. Then price turns around and breaks that very low. This is the powerful form because it broke a low the market had just defended. But be careful with your interpretation. That does not necessarily mean that buyers were deliberately led to the upside by smart sellers. Sometimes the market simply reaches an exhaustion point because no trend can continue forever. On the right, the market structure shift from a break of weak structure. Same uptrend, but this time price fails to make a higher high. Then it breaks the previous low, which was weak structure. This usually represents a smooth transition of power between buyers and sellers. Less violent, more of a handover than a rupture. Same event name, two very different characters. Now for the uncomfortable truth. Many smart money traders believe the market structure shift is the greatest pattern of all. It is not. This pattern can fool you exactly like any other pattern. A market structure shift can mean a reversal. It can also lead to subsequent traps, meaning subsequent market structure shifts. Look at the chart. Shift up, shift down, shift up again. It is not uncommon to see sequential market structure shifts, and each one will mislead you onto the wrong side of the market, right before it reverses again. The lesson is not that the pattern is useless. The lesson is that the pattern alone is never enough. Context and order flow decide, never the shape by itself. So what is the relationship between a change of character and a market structure shift? It is certainly possible to have a change of character without a market structure shift. Price might be in an uptrend and then smoothly transition into a sideways market without ever breaking structure. You can also have sequential market structure shifts that mislead traders, as we just saw. But when we talk about a transition between opposing trends, there will always be a market structure shift of some sort. With exactly one exception, the climatic reversal. A climatic reversal is marked by a clean, accelerated movement to one side, followed immediately by a clean, accelerated movement to the other side. A V-bottom or a V-top. There is usually no development of structure that will help you anticipate the reversal at all. The perception of the reversal occurs at a lower scale, which means you must pay much closer attention to the candlesticks themselves. We will do exactly that in Module 10. Everything we have covered so far is logical and quite simple. But a real price chart is more complicated than that. The reason is that price action is fractal. These patterns happen within one another. Inside the range and inside the pullback, you can usually detect two opposing trends. And in the transition between the range and the pullback, you can see one of the types of market structure shift, but at a smaller scale. This is enormously helpful. It is how you detect more precise entries and higher probability trades. Once you have a range and a pullback across two different degrees, two useful terms emerge. Swing structure, or major structure, is the movement outside the range and the pullback. It helps you determine the trend, and it locates good places for your stop-loss orders. Substructure is the minor structure inside the range and pullback. It is where you find minor market structure shifts and where you find liquidity inducement, which is simply a new name for an old pattern called a trap. Note what happens as you track more degrees. The movements get more chaotic, not less. It is useful initially to assume that highs and lows always have roughly the same size. But the real market is not that simple. Once you understand that markets are fractal, you arrive at fractal dimension. Think of fractal dimension as the degree of chaos, or the degree of roughness of market structure. In low fractal dimension, price action looks smooth, orderly, predictable. Your structure concepts work beautifully here. That is the left chart. In high fractal dimension, price action looks rough and chaotic, and is therefore far less predictable. Same concepts, much higher failure rate. That is the right chart. And this leads directly to the idea of multifractals, which is the recognition that fractal dimension itself changes over time. In other words, price action is an object with variable fractal dimension. It alternates between periods of low and high roughness. That alternation is a far more realistic picture of the real market than anything you will see in a typical structure course. As a piece of trivia, the word fractal comes from the Latin fractus, meaning broken or fractured. Two competing pictures of how markets behave. The efficient market hypothesis says prices instantly reflect all available information, and that movements are essentially random noise around fair value. Benoit Mandelbrot, the French mathematician regarded as the father of fractal geometry, proposed an alternative, the multifractal market hypothesis. Mandelbrot argued that markets are multifractal due to the diversity of market players, the diversity of time horizons, and the presence of feedback loops. It is a far more realistic view of financial turbulence than the efficient market picture. If you have any interest in markets and fractals, read his book, The Misbehavior of Markets. It is genuinely excellent. Here is why this theory has extremely practical consequences. The fact that price action is multifractal creates real problems for the common knowledge of market structure. For market structure shifts, for changes of character, for all of it. This is essentially why these ideas sometimes simply fail, and I want you to hear this clearly. It is not necessarily because you have not learned the right things yet. The market is genuinely irregular. 3 consequences. First, any time frame can fail. People who teach smart money concepts usually insist that you track multiple time frames, because higher time frame structure exerts greater influence on your home time frame. That holds some truth. But structure on any time frame can fail, and the additional effort of tracking many time frames often is not worth the marginal benefit. Second, you will find plenty of instances where minor structure wins over major structure. The hierarchy is not absolute. Third, effort versus benefit. Endlessly stacking time frames has diminishing returns. Most discussion around market structure, liquidity, and supply and demand focuses exclusively on price action. But that is only part of the story. To understand the market properly, you must also examine order flow, which is the underlying mechanics of price movement. Now, some smart money traders dismiss traditional order flow tools. Their argument is that a significant portion of trading volume, dark pool and over-the-counter transactions, is hidden from public view, and therefore distorts the public data. That criticism holds some truth. But it overlooks something critical. Price action is also distorted. Off-exchange trades do ultimately influence price, but they often reflect non-speculative behavior, like hedging or arbitrage, which does not follow the familiar logic of buying low and selling high. As a result, those trades obscure the meaning of price action, and therefore obscure market structure, just as much as off-exchange volume distorts public order flow. Price action and order flow are both incomplete in isolation. The key is not to discard one in favor of the other. The key is to understand the limitations of both and use them in complementary ways. Remember this: price action and order flow are market-generated information. They are not information that generates the market. They are effects, not causes. With those limitations in mind, here is the institutional toolkit. Market profile from Steidlmeyer's approach, which maps time against price. Volume profile, showing where volume actually traded by price level. The footprint, which shows bid versus ask activity inside each individual candle. Cumulative volume delta, which tracks net aggression over time. VWAP, the volume-weighted average price. And anchored VWAP, which is VWAP anchored to a chosen event or extreme. This is not perfect information, just as price action is not perfect information. But it is important nonetheless, and it is self-evidently important once you realize that these tools are common among institutional speculators. In fact, these tools were born in the institutional domain. One more connection. Time is regarded as an important factor by smart money traders, and there is a high correlation between time and volume in markets, as Steidelmeyer's market profile approach outlines directly. This module will change how you hear the phrase smart money. There are mainly three types of market player. The speculator is the participant who aims to buy low and sell high. Most retail traders are speculators, and there are institutional speculators too. A speculator profits from the directionality of price movement. The arbitrageur aims to profit by exploiting the relationship between two or more markets. This usually involves buying one market while simultaneously selling another, forming one combined trade. Imagine an arbitrageur buys market A and sells market B. Their profit comes from the relationship between A and B. If market A rises more than market B rises, there is a profit. The gain in A supersedes the loss in B, so even though they sold market B and it went up, they still profit. Notice what that does to your chart reading. An arbitrageur does not trade with directional intent, but their activity is absolutely reflected in price action and order flow. Arbitrage is extremely common among large institutional players. In futures, there is cash and carry arbitrage. In foreign exchange, there is triangular arbitrage. In stocks, statistical arbitrage is widespread. The hedger is the third player and the most misunderstood. Retail traders are usually not aware that hedgers are the highest tribe of smart money. They have access to primary information about the market. They are often large multinational companies with enormous capital power. A large bank can also operate as a hedger to offset credit risk. A hedger uses the financial market as insurance, not as a means of speculation. Consider delta hedging. A bank uses a combination of derivatives and the underlying asset to hedge directional risk. That operation involves purchasing call options while simultaneously short-selling the underlying asset. Read that again. Heavy selling appears on your chart. There is zero bearish intent behind it. Similar to an arbitrageur, the hedger does not want to buy low and sell high because he is delta neutral. He is trading the volatility of the market, and he can make money independently of market direction. So if you see a lot of selling taking place on a price chart, it is not necessarily because smart money is absorbing buyers or deceptively inducing sellers. It might simply be a hedger using the underlying instrument to become delta neutral. Now the second example, airlines consume vast amounts of jet fuel, which is derived from crude oil. If oil prices rise unexpectedly, their operating costs increase significantly. To protect against this, airlines hedge future fuel expenses by buying oil futures contracts. The logic is simple. If oil prices rise, the airline pays more at the pump, but their long futures position gains value, offsetting the increased cost. So if you see buying activity while price is falling, it is not necessarily because smart money is absorbing retail sellers to obtain liquidity, although sometimes it is. For this precise reason, the idea that price follows liquidity all the time is a myth. Price follows value. But value means different things to different market participants. Value in the eyes of a speculator is not the same as value in the eyes of an arbitrageur or a hedger. There is another claim worth dismantling. The argument that smart money requires the liquidity provided by retail traders is only partly true. One type of smart money, the kind that bases its actions on speculation, will do exactly that. But other types of smart money simply do not require retail liquidity because they have access to over-the-counter markets, which are vastly larger and have nothing to do with your price chart. Notice that a hedger buys or sells based on primary information. They could not care less about retail traders and the price chart. The good news is that we can track hedger activity. The Commitment of Traders report provides insight into what the highest tribe of smart money is actually doing. That is information you simply cannot obtain from a price chart, no matter how much price action and market structure you learn. So in summary, trading cannot be a perfectly mechanical game. The diversity of market players prevents that from happening. No matter how much you learn, uncertainty will never fully go away, and there are things that simply cannot be understood by looking at a price chart, or an order flow chart for that matter. One more concept before we hit the examples. Every notion of market structure taught in most channels assumes a leveled market. Flat highs, flat lows, horizontal references. But the angle of market structure alters your perception of trends, ranges, and the shifts between them. And that angle can only be perceived through trend lines rather than through swing highs and lows in isolation. Here is the connection to liquidity. Latent retail liquidity can come from any widely used technique, not just from the breakout of obvious highs and lows. Trend lines are one of these sources, because they are among the most widely used trading techniques in existence. Look at the chart. If you only pay attention to highs and lows here, it can be hard to understand why the strong structure failed. But analyze price in relation to the established channel, and it makes sense. Price fails to reach the upper trend line. That is analogous to price failing to break a previous high. Then price breaks the lower channel to the downside. Then price comes back to test that lower trend line as resistance. If you are only looking at raw price action, that retest might look like an initiation to the upside. With the trend line in view, it becomes clear the market is shifting downward. That is one example. There are many variations. Any widely used technique can have the same effect. Let us put everything together on a real chart. The S&P 500, 1-hour time frame. Here is a market structure shift already. Notice how price went down significantly, then started to retrace back up, forming a swing high. After that, price starts to go down, but it fails to produce a lower low. Therefore, it fails to render that swing high as a strong high. After the failure, we see price closing above the weak high. In other words, we have a break of weak structure. And in this context, that break transforms the failure into a strong low. This represents a shift in the behavior of buyers and sellers. Buyers have assumed control. Now, in moments like this, it is useful to look at the footprint chart so we can see exactly where buyers produced their greatest level of activity. 6 ideas to carry with you. 1. Extremes plus location. All of market structure reduces to highs and lows, and where price sits relative to them. 2. Strong beats weak. A break of structure relabels extremes. Trade around the strong ones and place your stops behind them. 3. Patterns can lie. Market structure shifts and changes of character whipsaw constantly. Confirm with order flow. Never trust a pattern in isolation. 4. Markets are multifractal. Structure fails partly because roughness genuinely varies over time. It is not always your mistake. 5. Not everyone buys low and sells high. Arbitrageurs and hedgers distort the tape. Price follows value, not liquidity. 6. Fuse the two lenses. Price action plus order flow. Read inside fractal context. That is where the edges actually live.